In this video, I'll be making the case of why dividends are the main reason why people should invest. Now, before you kill me in the comments, let me lay some ground rules and some context under which this statement applies. Because I do realize that there are many ways to invest. Investing is a very broad terms. And after having been in the market for many years, I understand that there are many ways to make money in investing or in the market. So the first thing I want to talk about here is the terms and conditions under which this statement applies. I do believe that if you're a long-term investor, then dividends will be your main source of return on investment. And this is the difference here. What do I mean by a long-term investor versus any other type of investor? The difference is not just short-term versus long-term. In my opinion, the difference is more investor versus trader. And I don't mean trader in, the bad connotation and the bad sense of the word. When you hear trader, you think of day trading, options trading, and all of these trading mechanisms that usually don't go well for, the person trading. But that's not what I mean here. What I mean is playing on the stock market sentiment. In this picture, we can see a laundromat. It's the most basic form of, any type of business. Very simple to understand. Also, very easy to make money from it. If you're an investor and you're trying to acquire this laundromat business, there's two ways that you can think about the return on investment. The first is to pay a reasonable price for the laundromat and then profit from having people coming in and giving the coins in order to wash their clothes. Every single week or every single month, you take the cash out from those machines and there you go. That's your return. And so what you're doing is you're actually profiting from owning the business. The second way to think about this investment is a play on sentiment. So what you're going to do is you're going to buy the laundromat when someone is selling it to you for a low price because they want to get rid of it. Maybe you're going to make some improvements in the laundromat. You're going to buy new machines. You're going to paint the walls to make it look nice. And then 5 years from now, when someone really wants to buy it and they're willing to offer a very high price for it, then you sell it to them. In this case, your return comes from the difference between the buy price and the sell price. So that's what I mean by the difference between long-term investing and trading. I think it's more of a difference in psychology or in mindset. If you're a stock investor, do you plan on buying the stock and then getting the return from the intrinsic returns of the business, whether that be dividends, buybacks, whatnot? Or are you buying the stock because the price is cheap and then once the price normalizes, then you'll be able to sell it for its fair value and then make a profit from that? So all of this is just to make a difference between both the investing and the trading. You can argue about my terminology all you want, but that's not the real focus here. That's also not to say that trading or playing on sentiment is a losing strategy. There's a lot of people that know how to do this really well. A lot of traditional value investors fall into this category. But personally, and for this channel, it's just not the way that we do things around here. If you're a long-term investor and you buy a business with the intention of owning it and holding the shares for a very long time, then in order for you to make money, the business has to, in some way or another, return capital to you. The first thing is that in order for a business to return capital to you, it has to be profitable. So the business has to be making money, it has to be profitable. Without profitability, then there cannot be any return of capital to the shareholders. So that's really the main precursor. Without profitability, there is no return. But once a business is profitable, then it can do a few things with the free cash flow that it generates. The first thing it can do is to reinvest in its own operations. So for example, if a company makes money, it can go and acquire another smaller company, or it can do some research and development to develop new products that will, bring in more profits in the future. It can do some market research, it can do marketing, it can invest in its sales team, etc., etc. The whole point of all of these expenses of reinvesting the money into that is to grow the business and grow the free cash flow into the future. So this option to reinvest in the business is option number one. Option number two is to actually give back some money to shareholders. And businesses can do this in two main ways, which is share buybacks or dividends. Like I said earlier, the purpose of this video is to make the case that dividends are the best way of returning capital to shareholders. But in theory, both buybacks and dividends have their pros and their cons. Let's start with buybacks by explaining what they are. Some of you watching this video will have more experience, and this will be very basic information for you, but just to put everyone up to date, a buyback is basically the company buying back its own shares from shareholders that are selling the shares on the market. So, say there's three people that are shareholders of a business, me, Johnny, and Bob, and Johnny wants to sell his shares. Well, the business can just buy the shares from Johnny, and now Bob and I are the only two shareholders left. So, the company spends some of its cash reserves in order to buy Johnny out. So the first thing about this process is that it's extremely tax efficient. Once the company pays its taxes on its net income, like every company does, the corporate tax, then it can really buy the shares using that net income from Johnny and pay no additional taxes. However, there are two main negative points that go in buybacks direction. The first is that they're subject to market volatility. So as you'll know, the price of a stock is not constant. It fluctuates a lot from one year to the next. If you go to any stock chart and you look at the 52-week low and the 52-week high, the difference is usually quite astounding, which means that the price that these companies can pay to buy back their own stock can fluctuate a lot depending on market sentiment. So what that means is that depending on whether the market is exuberant or very fearful, then the price that you're buying Johnny out is not going to be the same. If the company pays way too much for its own shares, then that can really destroy shareholder value. On the contrary, if the company pays a really good deal for the shares, then that can really create good value. So it's not a switch. Buybacks are not good or bad intrinsically. It really depends on the circumstances and on the price that is paid to buy back the shares. The problem is that, as you'll know, you're an investor. It's really hard to know when a stock is undervalued or overvalued. If it was easy, then we'd all be rich. You can look at a company's historical net income, their PE ratio, their price to free cash flow. At the end of the day, it's very hard to know whether the market is pricing a stock correctly or not. And as a result, it's really up to chance whether you're making a good investment as the company when you're buying back the share or not. So that's the first negative point for buybacks. It's volatility of the market. The second main point, which is, in my opinion, even more impactful than the first, is incentives. So you'll know that usually management and CEOs of companies are incentivized to grow the businesses that they're managing. And this growth usually is measured by revenue growth or by asset growth. Typically, though, it's measured by EPS growth or earnings per share. One of the quickest ways to boost your earnings per share in the short term is by buying back shares, because all of a sudden the share base is shrinking, your earnings are maybe staying the same, and so the earnings per share are still increasing. That's something that's entirely in management's control. They can flip the switch and decide to direct all of their free cash flow to buy back shares to boost the earnings per share in the short term. And at the end of the day, managers and CEOs and the executive suite, how long do they really stay in companies? If you look at most Fortune 500 companies, these executives are only there for 3, 4, 5 years at the most. So to them, what does it matter, the long-term prospects of the company, if they're able to get their bonuses, get rich, and then leave within a few years? So the incentives aren't always aligned between management and shareholders. Because remember, yes, shareholders benefit from share buybacks, but not if the price paid is too high. And unfortunately, there's many examples of management teams that have executed buybacks at precisely the wrong time. Let's take Boeing, for example. This is a company that struggled very much since COVID due to incidents like planes falling out of the sky. Well, Boeing was executing a ton of share buybacks between 2014 and 2019 when the stock was soaring. The problem is that the cash was disappearing from the balance sheet, and when the hard times do come, then there's no more free cash flow to buy back the shares when the stock is actually depressed. It's at a good price. So that's complete destruction of capital. And what about General Electric? The company was doing so many share buybacks in this range, and then once the stock is actually down, then there's no more money to do share buybacks. So as a shareholder, if this is happening, then you're the one getting screwed. Let's take two other modern day examples. The first is Apple. Apple has always done a ton of share buybacks, and it's worked out really well for shareholders. But there's always nuance to things. And if you look at the free cash flow multiple history of a company like Apple, it tells a story on its own. When Apple was doing buybacks in 2015 and 2016, then these buybacks were having a large impact because at that point, Apple shares were trading at 10 times free cash flow. Today, it's another story. The free cash flow multiple is around 39. And so even though Apple is spending even more today on share buybacks than it was in 2015, every dollar spent on buybacks is a lot less impactful because of this. And one day, if the Apple stock ends up crashing and goes down because iPhone sales will have slowed or whatnot, then this will come down as capital destruction. Okay, one last one, I promise. Nvidia, for example, announced last year that they were starting a share buyback program. And you think, oh wow, it shows confidence, they think that the stock price is gonna go even higher from here. But at the end of the day, this is still a company that's trading at a 66 price to earnings ratio and a 150 price to free cash flow multiple. So these buybacks aren't cheap. I apologize for the rant. Now we move on to dividends and their pros, which in essence are the opposite of the cons of the buybacks. The first is that dividends aren't subject to market volatility. It doesn't matter whether your share price is at 100 or 1,000. When a company distributes $1 billion to its shareholders, well, that's going to be divided proportionally to all the shareholders, regardless of the share price. So you're eliminating that risk, the market volatility risk that is very present with buybacks. The second pro of dividends is that it inculcates a certain form of financial discipline from management. Because if a company is committed to paying a dividend, well, that means that it's profitable, first of all. And the second thing is that management is going to try to prioritize to maintain that dividend and to grow it consistently over time, even if it's at a very slow rate. There's many reasons why management would want their company and the stock to be included in the lists of dividend aristocrats and the list of dividend kings as well, which are companies that have paid dividends for 25 and 50 consecutive years. And so in a way, when management knows that it has to allocate some of its free cash flow already to the dividend, it makes them more disciplined as to how to spend the rest. Now, the main con for dividends actually is their tax inefficiency, because once corporate profits are taxed in the company level and the company, uses those profits to send back to shareholders, then the shareholders are now taxed based on income. So it's that double tax rate that's really the killer for dividends compared to buybacks. If you've made it this far into the video, congratulations to you, my friends. Remember to show your support to the channel by liking the video. It's completely free. And you can also subscribe to the channel if you like this type of content. Now we're going to get into the meat and potatoes of the content of this video. And we're going to go back to the original premise. And now I'm going to explain why dividends are so important. To be brutally honest, if a business never pays its shareholders any dividend, if there's never any return of capital via the dividend method, then that business is worthless. Yeah, I said it. I'll say it again. The business is worthless if it never pays any dividends. The key word here is never. Never over its entire life cycle. If the business you own will never ever pay you any dividends at all, then the only return you can actually get is from selling your shares in return for cash to the next sucker. And that's all based on sentiment. Now, I'm going to use an example to illustrate this, and we're going to go back to my beautiful laundromat here. You're going to help me finance this location by giving me $1 million. You're going to become a 50% shareholder, and we're going to start up this little laundromat business. Now, right from the start of the investment, when you sign the contract, I'm going to tell you that I'm never, ever, ever going to pay you any dividends. Your shares will never receive any dividends from this business. Any profits that the laundromat generates will never flow back into your pocket via a dividend. How are you going to make any return at all? Now, you can always make a return by selling your shares to somebody else, but either they would be a fool for buying those shares from you, or you would be evil because you didn't tell them that they will never pay any dividends. It's one or the other. Because think about it, what's the point of owning a laundromat if you're never ever going to see any profits from it? The life cycle of a business is typically like the chart I'm showing here. The business gets formed, it grows over time, then it matures, and then slowly it dies. For 99.9% of businesses in all of existence, this is what their existence looks like. Say you invest right at the start when the business is first opening, and you hold the shares throughout the growth stage, throughout the maturation, and through the decline as well. And say that during all this time, the business never pays you any dividend at all. If this cycle lasts 50 years, then at the end of the 50 years, you'll end up with shares that are now worthless because the business is dead. It doesn't matter how much the business invested in marketing or in R&D or how many buybacks they did. Maybe they put all of their free cash flow in buybacks and you're now an 80% shareholder at the business death. Well, 80% of zero is still zero. At the end of the day, how much capital the business will return to shareholders in the form of dividends is the true value of the business. Okay, so at this point, you're probably thinking, but what about the companies that don't pay dividends? The most famous and the biggest one is probably Amazon at this point. The company's never paid a dividend and it's still worth $2 trillion today. The thing is, for companies that don't pay dividends today, the expectation is that they will pay a dividend someday. If I'm a shareholder of Amazon today, maybe I'm okay with them not paying a dividend. Maybe I even prefer that they don't pay me a dividend because they can get a high return on investment by reinvesting into the business. I want them to build new products. I want them to invest in their ad business, into the AWS and all that. Because my thought is that if they grow these businesses, then someday down the line, they'll be able to pay a much bigger dividend. So the entire value, the entire market cap, the entire value of the business today is predicated on the assumption that one day Amazon will be able to return a whole bunch of cash to its shareholders. So as a company buys back its own shares and grows its free cash flow, even if they don't pay a dividend, the expectation that they'll be able to pay a very big dividend increases. And so the value of the shares also increase. But like I said before, if all a company does is reinvest in itself and buy back its own shares, eventually that company will die one day. And if it doesn't return any capital to the shareholder, then you're left without anything. If you're a long-term investor, at some point you're going to want a liquidation event. Because at the end of the day, you're a human. You want to be able to use your money and to spend it the way you like. And in business, there's only two real ways of getting that liquidation event. The first one is the dividend, which we've already talked about. The second one is to sell your shares. If you're relying on selling your shares in order to get that liquidation and get cash into your pocket, then you're subjecting yourself to volatility, same as the share buybacks. And once again, at the fear of repeating myself, it's very hard to tell if the shares of the business that you're currently owning are undervalued or overvalued or what the future holds. Imagine you're going for your retirement and you retire here in 2000. If you're relying on selling your shares in order to fund your lifestyle, it's going to be a rough 15 years for you. All it takes is one unexpected event like a bubble bursting or an extended recession, and all of a sudden you're in trouble because the assets that you're selling are worth a lot less at the moment that you need to sell. You're time constrained. You have no choice but to sell at that moment. The other thing is that you're trading in cash for a productive asset. You're trading the part of the business that you own that will produce an unknown amount of cash over its lifetime for cash, which is a non-productive asset. So in a sense, you're limiting your potential future returns by doing this. On the contrary, a dividend allows the investor to fund his own lifestyle or her own lifestyle, to invest in other businesses as they wish, without ever getting rid of the productive asset that's generating those dividends. So let's go back to the retirement example. Say a couple retires in 2000 and they see the value of their portfolio go down over the next 10 years. Well, maybe the value of the businesses is going down because the businesses are now making less money because it's a recession. And as a result, maybe the dividend payments are lower for 10 to 15 years. But that's not a finite thing. As soon as the business starts to perform once again, then the dividend payments will creep back up and their lifestyle can keep going as it was before. It's also entirely possible that the businesses don't reduce or cut their dividends if they chose wisely. So to summarize, dividends are the lifeblood of the investment. Unless you're trading and playing on sentiment, the only reason why you buy a business is to get those dividend payments eventually. If not today, then in the future. There's no point in having your name on an asset that's never going to share its profits back with you. On the platform I manage, which is called RatedA, we only cover companies that pay dividends currently. There's two reasons why we do that. The first is more practical, is that it narrows down the investment universe so that we have less stocks to cover overall, and it gives us more focus. But the second reason, which might be even more important, is that it eliminates a lot of crap. A lot of companies that are either unprofitable and cannot pay a dividend, and also companies that are not paying a dividend now, but also will never pay a dividend in the future. At the end of the day, it's the sacrifice that we're willing to take. Yes, we might miss out on some companies that are not paying a dividend today and that are focused on growing in order to grow that potential future dividend one day. And that's fine. But we're also going to miss out on a ton of BS companies that will probably lose you money over the long term. All right, that's it for this video. Thanks for watching, and I'll see you in the next one.